6 weeks ago, something happened that changed the financial landscape in a way that most investors are still catching up to. February 28, 2026, U.S.-Israel launched joint airstrikes on Iran. And within days, Iran closed the Strait of Hormuz. Not going to tell you about the Strait of Hormuz, not going to tell you what's going on with Brent crude. Today, April 16th, Brent is sitting around $98, $97, $96, still highly elevated, volatile. And in 2-week ceasefire that was agreed on April 8th is set to expire on April 21st, in 1 week. We're not here to tell you what happened. We're here to walk you through a quantitative model built before this war started that projected exactly this kind of scenario, and more importantly, to show you what the model says comes next. You are going to understand the range of outcome the model is projecting, and you are going to have a concrete framework for thinking about what to do as an investor right now. Before we get into the projections, let me take a few minutes to make sure you are all reading the same map, because this chart has a lot happening to it, as you can see. And if you have ever seen something like this before, it can feel overwhelming at first glance. So slow it down and walk through it. At the top, you see projected market fragility confluence, perfect storm scenario. That word confluence just means multiple forces flowing together into the same place at the same time, like rivers merging. We will come back to why this is so important. So on the horizontal axis, this is the timeline. Along the bottom, you will see Q minus 2, Q minus 1, 0, plus 1, plus 2, plus 3, plus 4. These are quarters, 3 months periods measured relative to oil shock event. Q0 is February 28th, 2026, the day the war started. The day the Strait of Hormuz began shutting down. Everything to the left of Q0 is historical. Everything to the right is projected. And here's a critical update in this version of the chart. You will see a yellow dotted line sitting halfway between Q0 and Q plus 1. That line is basically labeled today. We're not standing at the trigger point anymore. We are already 6 weeks into the post-shock window. The projection has already started unfolding around us. The left axis, the left side of the chart, is the aggregate fragility index. Think of it like a thermometer, measuring how stressed the overall financial system is. 0 is calm. The higher the number, the harder the system is running. At Q0, this index was at 82. This is already significantly elevated. And in the projected scenarios going forward, it climbs further. On the right axis, you see oil and concentration. The right side of the chart carries two things simultaneously: crude oil prices in dollars, and then, of course, the S&P concentration percentage, meaning how much of the entire stock market is controlled by just the top 10 companies. Two different measurements, same axis, because both tell a story about how fragile the current system is. And then, of course, you've got the 4 lines. The light blue line is crude oil. It starts around $65 a barrel before the war. Then it spikes hard to Q0, peaking at $126 in March 8th. Today, it sits around $98. That line is real. That has already happened. The red-orange line is the S&P 500 concentration. It sits at 41.2% higher than now. This is an all-time record. It has never been this concentration in the history of the index. The solid gray line is the overall aggregate fragility index. It is elevated before Q0, and it climbs into dark red shaded zone after that. The dashed red line close to the zero, close to the bottom, is the floating red credit stress index, a proxy for private credit health. Notice it has already been climbing steadily since before Q0. This is the private credit default rate, which now sits at 9.4%, an all-time record. The red cone, that fanning red zone, right, to the right of the Q0, that is a prediction cone. It widens as time goes on. The width of that cone is telling you something critical. The further out in time we go, the wider the range of possible outcome becomes. Some outcomes are uncomfortable. Some are seriously damaging. And one thing slides at the top is catastrophic. Think of it like a hurricane track forecast. When the storm is 3 days out, the cone is narrow. But then it gets wider and more dangerous. This chart is exactly the same thing for financial risk. Now, you will see reference to a Gauss model and Monte Carlo simulation. I will explain what those means in plain English a little later, but for now, just understand this is a real quantitative model built on live data. Brent at $98, S&P concentration at 41.2%, private credit default rate at 9.4%, and US debt at 123% of GDP. These are not hypothetical inputs. These are happening right now. Now, before I go any further, if you're finding this kind of deep analysis valuable, do me a quick favor and hit that subscribe button right now. We do this every day, breaking down complex financial data into a language that actually makes sense. No hype, no panic, just pure analysis and education, not prediction. Let's get there. So, pressure point number 1. The Strait of Hormuz have been effectively closed to U.S. and allied shipping since February 28th. It's closed. Okay? In that time, Brent crude has gone from $75 to a peak of $126. The highest since September 2022. It has pulled back to around 98, 95, 94, 97, largely because of a 2-week ceasefire. But here's the thing about that ceasefire. It expires in 1 week, on April 21st. Talks over the weekend in Pakistan failed. After 21 hours of negotiation, the U.S. then announced a naval blockade of Iranian ports. And today, while Iran and the U.S. have seemingly willingness to continue talking, there is no deal. Morgan Stanley is projecting Brent at $110 in second quarter and $100 in third quarter. Goldman Sachs, the more optimistic scenario, sees $90. Neither bank is projecting a return to pre-war levels this year. And this matters far more than just gasoline prices. Oil is embedded in everything: food production, manufacturing, shipping. When oil stays elevated, inflation stays elevated. And when inflation stays elevated, the Federal Reserve faces a very uncomfortable dilemma, which is a fourth pressure point we will get to shortly. As you could see, this does not look good. To put it in real time, if you have $100 invested in the S&P 500, right now, 41 of those dollars are sitting in just 10 companies. Most of them heavily tied to artificial intelligence. Most of them trading at price-to-earning ratio above 30 times earnings, versus a long-term average closer to 19 times. JP Morgan issued a tactical buy signal on the S&P on April 13th, after a 5.2% pullback from the recent high. But here's what they're really telling you. The index has already started correcting. And with concentration this extreme, any sustained selling in the top 10 names does not stay contained. It takes the whole index with it. Pressure point number 3. This is the one that does not make the front page, or kind of, but it gets forgotten. But in terms of structural financial risk, it may be the most dangerous of all 4 pressure points. Remember, stock market crashes not because of poor earnings. The stock crash because of lack of liquidity. Over the last several years, a $1.7 trillion private lending market grew to fill the gap left by traditional banks. Thousands of mid-sized businesses, too big for local banks, too small for public bond markets, borrowed heavily from credit funds. Almost all of those loans came with floating interest rates. Floating rates means exactly what it sounds like. The interest payment adjusts with benchmark rates. When rates were near zero, those payments were manageable. When rates climbed and stayed elevated, those same businesses started paying double or triple the interest they originally budgeted for. The result is that Fitch privately monitoring rating business universe hit a 9.4% default rate in January 2026. That is a record since they started tracking it. In the broader measure, 9.2% of all companies in the universe defaulted in 2025. UBS has put a 15% worst case scenario on the table for 2026. Morgan Stanley is forecasting 8% in direct lending tied to AI disrupted software companies. And here's a critical thing about private credit stress. It is invisible in real time. These loans are not publicly traded, so you don't know what's going on. You don't hear. They don't have a daily price tag. The damage builds quietly like the 2008 financial crisis. That is what the dashed red line in the charts represent. And you can see it has been climbing steadily since Q0. Think of it like the plumbing behind your walls. You do not see it every day, but when a pipe bursts under pressure that has been building up for months, the damage to the house is very real. Pressure point number 4. In past downturn, 2008, 2020, the US government response was to spend massively. Stimulus checks, bailout program, relief packages, and it worked, at least in cushioning the immediate blow. But each time the government does that, the debt grows, and the interest payment on that debt, the annual cost of servicing what has already been borrowed, now exceeds $1 trillion per year. In the first 9 weeks of fiscal year 2026 alone, the Treasury spent $104 billion just in interest payments, more than $11 billion a week. The CBO projects a deficit this fiscal year end at $1.9 trillion. The debt to GDP ratio is 123%. And in 2025, in May, Moody's downgraded U.S. credit, AAA for the first time since 1917. So the fiscal straitjacket, the bullet on the chart, mean this: when the next crisis hit, the government's ability to simply write enormous checks to fix it is more constrained than it has ever been during any modern crisis. That does not mean stimulus is impossible, but it means it is slower to arrive, more politically complicated, and potentially inadequate relative to the scale of what is needed to address. Think of it as a fire department that already took out massive loan last year. They can only fight fires, but they cannot buy as many new trucks as quickly when they need them most. Now, let's spend a moment to think about what people are not fully processing. The difference between a stress and a shock. A stress is something that builds slowly, right? High level of debt builds slowly. Rising default rates, elevated market concentration. These are stresses. They accumulate over months and years. They create fragility into the system, but on their own, a fragile system can hold together for a surprising long time. A shock is sudden. It's fast. It overloads a system that was already under stress. And when the shock hits a fragile system, one is already stretched and thin across multiple pressure points. The combination is not two problems. It's a multiplier. This is exactly what happened on February 28th. The old shock did not arrive into a calm, well-capitalized, low-debt financing environment. It arrived into a system with record stock market concentration, record private credit defaults, and the most constrained fiscal position in modern history. It lit the match in a room that was already full of kindling. And here's what makes the April 14th version of this chart so important. In the original version of this model built before the war started, Q0 was a hypothetical future event. It was a scenario, something the model was warning could happen. Today, Q0 is 6 weeks in the past. We are sitting at Q0 plus half a quarter. Right at that yellow today line in the chart. And the question is no longer whether we trigger the fires. The question is how far the chain reaction travels. That is where the black swan becomes essential. So oil shock is Q0, the match that was struck. Now let us talk about every domino that falls next, the 5 vectors inside that red cone. Inside the red cone on the right side, you can see 5 arrows, 5 labels. Think of them as 5 dominoes. The oil shock knocked over the first one. Now, we watch to see how many will fall. First of all, when oil shock keeps inflation elevated, central banks face pressure to maintain higher interest rates. And when interest rates stay high, one category of investment gets hurt far more than the others: high valuation technology companies. The chart labeled this vector correlation decay. High PE sensitive to rates. The top 10 companies in the S&P 500, which now represent 41% of the entire index, are predominantly in this category. They trade over 30 times forward earnings. The long-term average is closer than 19 times. That gap represents the premium investors are paying for future growth. The market recalibrates. And when the companies that make up 41% of your index get recalibrated, you feel it everywhere. Vector number 2. The top companies in the S&P 500 right now are heavily tied to AI expectation. Nvidia, Microsoft, blah, blah, blah. These are companies people invest in at 30, 40, 50 times earnings just because what AI is expected to deliver. Those expectations are baked into the price. When an oil shock creates an inflationary environment that keeps rates elevated, those future AI profits get discounted harder. The result is a re-rating, prices adjusting downward to reflect a more realistic relationship between today's earnings and tomorrow's expectation. The dot-com parallel is instructive. The internet was absolutely real. It did transform everything, but in 1999 and 2000, investors were paying prices that only made sense if every internet company became the next Amazon. But they did not. The technology survived and thrived. The company did not. And notice the arrow at the bottom of the cone. And notice the arrow at the bottom of the cone, right? Shifting to value stock. That is the flip side. When expensive growth names reprice, money rotates historically towards companies with lower valuation. Real earnings today, actual cash flow, energy producers, industrials, financials, not glamorous, but much better positioned in the environment the chart is projecting. Vector number 3, the private credit squeeze. We covered the 9.4% default rate in the current state section. But the chart is modeling something more specific, the chain reaction that follows when that number keeps climbing. When a company cannot cover its interest expense from its operating income, the first thing that happens is a covenant breach. A covenant is just a condition written into the loan, something like your debt cannot exceed 3 times your earnings. When those conditions are violated, the lender can demand immediate restructuring or repayment. For a company already struggling with elevated floating rate costs, a covenant breach is often the thing that pushes over the edge into full default. And when defaults happen in private credit, the losses ripple through the balance sheet to whoever funded those loans: insurance companies, pension funds, retail investors in semi-liquid vehicles. And here what makes this vector particularly dangerous. In the current environment, the Hormuz closure is directly inflationary. Higher inflation means higher rate stays elevated longer. Rates staying elevated means those floating rate payments stays elevated. More companies hit the coverage threshold, more covenant breaches, more default. The dashed red line in the charts keep climbing. Blue Owl Capital, one of the largest private credit managers, restricted retail investor redemptions recently. Shares have dropped more than 60% from the late 2024 highs. This is not a signal from the periphery. This is a signal from the center of the private credit world that the stress is real. This is exactly the kind of analysis that shapes how I position my own portfolio, which is something I walk through in detail with members of this channel. Membership gives you access to my personal portfolio building process where we tinker about everything every day. Not generic advice, not a list of tickers, my actual thought process. The link is in the description. The vector number 4 appears later in the projection, around Q plus 3. Normally, when the economy weakens, the Federal Reserve cuts interest rates. Lower rates makes borrowing cheaper, encourage investment, and spending stimulate growth. We saw this work in 2001, 2008, 2020. Cut rates, cushion the blow, stabilize. But here's the problem specific to an oil shock-driven recession. Oil shocks cause what economists call supply-side inflation. Prices are not high because people are spending too much and demand is overheating. Prices are high because a physical supply of something critical got disrupted. And cutting interest rates does not fix a supply disruption. It just risks making inflation worse at exactly the wrong moment. Remember what happened in 1973 with the oil shock, right? Where basically OPEC hiked prices. Do you know how much the stock market dropped? Almost 40% over 12 months. So the Fed faces a genuine trap. Keep rates elevated to fight the inflation, and you push the private credit market, extend the AI valuation re-rating, and slow the economy into a hard landing. Cut rates to support the economy, and you risk letting oil-driven inflation run hotter, potentially triggering a second wave of price increases. Remember 1980? Remember Paul Volcker, what happened? There is no clean level to push. Both options are very serious costs. This is the trap. And when the central bank is stuck, when the primary tool for fighting downturns become blunt, the system has to absorb the shock largely on its own. Now layer in on the fiscal straitjacket and the government paying more than $1 trillion a year just in interest, a deficit already running at $1.9 trillion, a credit rating that was downgraded. The cushion that existed in 2008 and 2020 is thinner now. So the fifth vector that you want to take a look at is the emerging result of all other combining, and the chart tracks this with that white line, right? The aggregate fragility index, which entered Q0 at 82, and the model projects climbing towards 102 by quarter plus 4 in the baseline trajectory. I mean, the concept behind this is that what engineers call cascading failure. One breakdown makes the next breakdown more likely, which makes them one after that more likely. Dominoes, not just 5 in a row, an entire room of them densely packed. When S&P concentration is set at a record high and AI valuation are stretched and private credit is already stressed and the government has limited stimulus capacity, the central bank is caught in a rate trap. These are not 5 separate problems. These are 5 interconnected vulnerabilities. When one gets triggered, the other feels it immediately. The fragility index is measuring how density packed the room is. At 82, we are not in a safe room. The model is telling us that in several of its projected scenarios, things get more tightly packed, not less, and we move through Q1 to 2 and beyond. Now, let me explain the numbers at the bottom box of the chart, the Gauche model and the Monte Carlo simulation. Plain English, but it's important. Gauche is a mathematical model, right, that for estimating how volatile, how unpredictably the market is likely to move based on how stressed it has been recently. Think of it like a doctor who has been monitoring your blood pressure for a year, and based on the pattern, how elevated it has been, how volatile, she can make statistically grounded projection on what your blood pressure might look like under different stress conditions over the next 6 months. Not a guarantee, a calibrated estimate. In this model, the input are the oil shock, $33 per barrel, above pre-level wars, right? S&P concentration of 41%, private credit default rate at 9%, and US debt to GDP of 123%. Every input is live as of today. So now let's take a look at the probability of outcome. As you could see, we have 40% probability of contained stress. Add these three scenarios together, and this model is assigning 60% probability to outcomes ranging from meaningfully painful to historically catastrophic. Now, before that number causes panic, let's take a look at the first one. 40% probability of contained stress. Basically, fragility stays below 88 through fourth quarter, almost resolved quickly after April 21st. Oil fades, private credit stress is isolated, and AI correction is mild, and Fed navigates imperfectly but manages. 20% probability. The fragility climbs to 93 to 96. Hormuz closure extends for 2 to 3 months, which we are on our way. Some private credit cascades. Take valuation corrects 15 to 25%. Mild recession, painful but recoverable. Best buying opportunities emerging, 20% probability. 35% probability you have a serious storm. Multiple vectors activate together. Equity market down 30+%. Credit spreads widen sharply, which they have quite a bit. Fed trapped. Recovery measured in years, not months. And a 5% probability. Our black swan cascade, full cascade, oil shock, credit seizure, equity free fall, policy failure. Now you add these three scenarios together, and then the model is assigning 60% probability, right, to outcomes ranging from meaningful, painful to historically catastrophic. Now, before the number causes panic, I want to be precise about what it means. This is not a model saying the world ends. The 40% contained scenario is real and possible, but the probability distribution is skewed towards the downside in a way that demands attention. Not paralysis, attention. And the 5% black swan cascade, the scenario with the smallest probability on the chart, has consequences so large that it deserves 5% of your planning bandwidth. Because 5% is not zero. Now, the most important practical point I can make, models like these one are extremely valuable for understanding the shape of risk. They are far less useful for telling you the exact date something breaks. Markets can stay elevated and calm for longer than anyone expects, even when the conditions are fragile. What this analysis is most useful for is portfolio construction. Make sure your overall exposure is not completely vulnerable to any single bad outcome. Spread it out, build buffers. The investors who do best in periods like these are rarely the ones who predicted exactly what would happen. They are the ones who thought through the range of outcomes ahead of time and positioned themselves to survive and adapt to any of them.